So I think we will start. I think people will probably join us after the lunch, but I don't think we should wait too much. If not, we will put everything at risk later. So I'm delighted. I'd like to thank the organizers for giving us the opportunity to discuss what I consider personally, and I think a lot of people consider essential issue that has always hampered for long development in southern countries, and I'm talking about the lack of reliable data available for assessing credit risk for corporates. This will enable us to properly frame the context, identify issues and challenges, and talk about new avenues to tackle them. We will do that by combining observations, the context in general, reflecting around the technologies we could use. We will definitely talk about experiences in this environment, without obviously forgetting all impacts on institutional framework, associated risks, and regulations. So let me briefly introduce my fellow panelists. In order of appearance, Florian Léon. He will start the presentation. He's a research officer at FERDI, associate researcher at SDGs. Florian is focusing his research on finance and private sector development in Africa. So he will be the first one to intervene, and he will probably give us an element of context around the issue. Then we will move to Bernardo. Bernardo is with us remotely with a wonderful investment banking tie. The 23 years of work in the financial sector, 11 years in Mozambique. He is the CEO of Standard Bank in Mozambique, one of the largest regional bank in East Africa. He will give us its regional bank's perspective on lending to businesses and specifically SMEs. He will obviously, I'm sure, talk about the legitimate ambitions of the bank in that matter, and also the constraints he encounters in assessing corporate credit risk. Then we will move to Catalina. I especially thank Catalina because she is at the initiative of this session. She is a professor of management science and faculty lead in analytics and artificial intelligence at the European School of Management and Technology, ESMT, in Berlin. She will help us understand how machine learning and AI can play a critical role if we want to change paradigm in corporate default risk analysis. Then we will end up with Esselina. I guess most of you know Esselina already because she intervened on previous panels. So I will still present her because there are plenty of things to say about you, Esselina. So you are an associate professor. So in this environment in which academics is clearly valuable, it's important to mention it. So you professor at the Edward de Mondlane University. You had a lot of following degrees in various jurisdictions on mathematics, information systems. With us, you will provide valuable insights on the issue, as you've been for years at the board of the central bank in Mozambique, and more recently, and in your current capacity, you are at the board of the Facility for Financial Sector Development in Mozambique. Inclusion is at the core of the strategy of this institution, and probably more than anything else, I would stress the interest that this entity is having on vulnerable persons, women, youth, people with disabilities, and rural and low-income populations of Mozambique. Obviously, small businesses development is key for you, and I'm sure that you will have very interesting insights on regulations, the way central bankers looked at those things, personal data protections, plenty of things related to avenues that we'd like to cover. So I think we should move then to Florian. Just as a reminder, we all know, and that's what you will probably tell us with more words and more data. We all know the private sector plays a crucial role in promoting the sustainable development in developing countries. It is generally accepted that there is a link between wealth and job creation. It is essential to improve living conditions of populations. And to get there, we would like to have a sustainable strengthening of the economic fabric of in Africa. But that implies addressing challenges facing corporate entities. That's up to you to give us a bit on that.
Thank you, Christophe. Good afternoon, everyone. It's a pleasure to be here to start this session about data and credit scoring. My aim today is to provide a global perspective on this subject, and my main challenge is to explain why data availability and credit scoring is important for development and for private sector development, but for development in general. Indeed, credit scoring might be like a purely technical issue, but as we try to explain, it's not only a technical issue, it's also a more general issue, and it's very important for private sector development. To do so, I will focus on two key points. First, why the private sector in in Africa and other low-income country is so crucial. And second, how credit scoring and data availability, among other tools, can help to improve access to credit and therefore to spur private sector development. Just let me start with private sector itself. As Christophe said previously, we all know that vibrant private sector is important for development. It creates jobs, generates innovation, generates wealth. It has many indirect impacts on social inclusion and so on. It's clear. But what we observed in Africa and in other low-income countries, we observe that indeed private sectors lag behind in comparison with other countries and even other developing countries. So just let me share a few facts to illustrate this. As you know, most economic activity remain informal in these countries. According to recent estimate, 3/4 of all jobs in Africa are informal in the urban sectors, and certainly more higher number of jobs are informal in agricultural and rural sectors. Secondly, even if we focus exclusively on formal firms in these countries in Africa, what you observe in comparison with formal firms in other countries, we observe two things. First, these firms are smaller, and second, these firms are less productive than SMEs in other countries. Indeed, the problem is not a problem of entrepreneurship. There is not a lack of entrepreneurial energy in these countries. There are many entrepreneurial initiatives in these countries. But many firms struggle to grow beyond the initial stage. And they face many obstacles during the growth phase. When an entrepreneur wants to transform his firm as a big firms, okay? So there are many reasons explaining why firms and entrepreneurs struggle to grow over the life cycle. And these obstacles are from internal challenge within firms to broader macroeconomic issues. But one factor is particularly important: access to credit. Surveys as academic research show that this is one of the biggest obstacles for SMEs, alongside challenge like access to electricity. And entrepreneurs need external funds to invest, to grow, but they often fail to secure loans. So it's the second part of my presentation. Why? Why is access to credit so difficult in Africa and in other low-income countries? We should keep in mind that indeed lending is built on a single promise. You lend me money today, and I will pay you back tomorrow. And this promise is by nature asymmetric. Why it is asymmetric? Because the lender bears the risk, while the borrowers hold all the information about the project, its detail, its potential, its risk, and also its own motivation to implement the project. So, as you know, the information asymmetry creates two major challenges for lenders. First, adverse selection. Lenders struggle to discriminate between good and bad borrowers. And secondly, moral hazard. Lender can be certain how the borrower fund, how the borrowed fund will actually be used. Traditionally, lenders manage this risk by asking for detailed financial record, audited financial record, or a proven credit history. However, in many African countries, SMEs, small entrepreneurs, lack these assets and record. So they are disqualified from formal credit. And it's the moment where credit scoring and data access is so important. Why? Indeed, there are many innovations in credit scoring, and innovations are happening in two key areas. The first, and maybe the most important one, is the use of new and alternative data. We don't longer rely exclusively on audited financial record, but on new data, such as transactional data, mobile money data, and so on. And I'm pretty sure that the other panelists will discuss in detail this innovation. Secondly, a second innovation is new model can be used to trade this new data. And we have new advanced statistical model to be more able to distinguish between a good and a bad borrowers. So for lenders, this means making better decisions and reducing default rate. And for entrepreneurs, it means either access to credit when they need to grow, even if they are not able to provide the traditional audited financial record. So just to briefly sum up my main message. Indeed, credit scoring and data access is important because this different innovation helps to improve access to credit, notably for the most promising firms. And these firms are important for economic, obviously, but not only economic, but social, maybe environmental development. Thanks.
Thank you very much, Florian. I think it would be probably easier to move to you, Bernardo. You could probably give us your views on what a bank is expecting to do. Sorry, here you are.
Sure. Can you hear me?
Perfectly.
Okay, great.
So go ahead.
So thank you very much for the invitation, and apologies for not being there in person. That was my first objective, but I get drawn to other places sometimes, which are much less pleasant to be than speaking at your conference. So I didn't want to miss it, and thank you for making it available for me to join through video conference. So I think generally what Florian just said is quite accurate. What we see in markets such as Mozambique is that the percentage of our total balance sheet that goes to SMEs in terms of credit, in terms of loans, is extremely low comparing to developed markets. So in our case, for example, Standard Bank, we lend about 7% of our balance sheet to SMEs, which is very small. And then when you look at, and within those 7%, we have some SMEs that turn over $5-10 million. But when you look at the small ones below $2 million turnover equivalent, it boils down to maybe 2% of the whole balance sheet of the bank. And across the market, it's not very different. Our estimate is that less than 10% of the loan book goes to SMEs at this point. We're seeing either banks are very comfortable playing in the large corporate space, public sector companies, large mid corporates, or they're very comfortable playing on the consumer market, consumer loan market, public employee loan market, which you have much more data, longer data, and it's easier to score through the credit scoring model. So what's really the issues? A lot of it starts with lack of credit history. When they borrow for the first time, they have no history among our financial institution usually. That's where we have access. And there's no credit bureaus that can vouch for the credit history of the client. As you move down the scale of the company, the lack of organized accounts, the fact that it's not mandatory to have accounts organized and even signed by an accounting firm below a certain amount, there's this symmetry of information, as Florian said, where what we're looking at is a piece of paper or an Excel sheet, which is created by someone that has the incentive to get a loan. So that the symmetry of information is due to lack of organized account. There's also very limited future cash flow visibility. So when entrepreneurs or business owners, they project their business in a very short term. African markets are in general very short term because of the volatility. But also when you ask for projections, when you try to look at the projections from the clients, it's very short term. It's the next working capital cycle, the next 6 months, the next sales, something like that. And that limits the ability for us to lend on a long-term basis. Volatile markets, they operate both from a macroeconomic perspective. Remember that in most of our markets, inflation is high interest rates, high inflation, devaluations of currencies that affect certain sectors more than others. So those are also inputs that go into the credit analysis and make it more difficult. But also you have volatility on the sectors and the markets they operate as businesses, where it's easy to enter in some of the sectors where their capacity to create a network effect is very limited. And then the last one that is clearly a blocker that we see is poor governance. A lot of it is one key man dependent, no governance structures, and when you put that all into a type of traditional credit scoring, it's very difficult to lend. So when we have our traditional, what we've had so far, and it's clearly not working as a market, and not only as a bank, but as a market, is we do always rely on a balance sheet and a P&L. So if they don't have it or have a very poor one, the credit gets penalized, the appetite reduces. Sometimes we rely on tax fillings, but in a lot of these markets, tax is a flexible thing, right? You want to pay the least of the taxes because you don't have organized accounts or mandatory organized accounts. You decide how much tax you want to pay, so how much do you want to declare, and then your balance sheet looks worse because when you compare the balance sheet that they're giving you against the tax fillings, you end up having either a financial risk that you're seeing, or even worse, you have an AML risk, anti-money laundering risk. So if the client is declaring taxes less than he's telling me that he turns over, so it creates another lack of trust issues. And when we apply the lenses of what happened historically, due to the volatility of these markets, we apply very high loss rates to specific segments, to certain sizes and certain sectors, which tightens our credit appetite. And worse off, sometimes we try to apply a judgment-based expert credit analysis, which is basically applying the lenses of credit analysis for a large corporate into a SME. And this is what we're trying to run away with. One of the projects, we have more than one project on the go to move into alternative credit scoring techniques, but one that we're working with Catalina. It's really about how do we do credit scoring with alternative data and techniques. I hope she can give us more details than I can. But for us, it's really identify, work on our side will be to identify relevant alternative data sources that can influence the SME creditworthiness. So what other things, a lot of them could be behavioral, could be sector. We're looking at bureaus, of course, and account behavior, but also maybe look at what suppliers does he have, what type of clients do they have, and what ecosystem is this company inserted in. What is the interaction with other banks and with mobile wallets, which is something very key here. So we need alternative data, and we need to remove the human bias of the credit analysis away and test it to see if that works for us. So we need to really implement and compare various machine learning models for credit scoring using this alternative data. And then really pilot it, put some capital into it. A lot of these things don't work on a theoretical basis, so we have to allocate capital. And let's say we're willing to lend 100 million meticals, which is $1.5 million to SMEs on a specific model, because we might lose X. So that's going to be our investment. And with that, we can assess the predictive power and reliability of these models against the conventional scoring methods. I was actually having a conversation with a colleague of mine, our CRO, and I was telling him I want to put an analysis of 10 companies in a model and in a person and see who's wrong. And not from a wrong for who should have lent and shouldn't have lent or high NPL, is what is the thinking around lending or not lending. There are limitations, and in some of our markets, Mozambique is one that has more limitations on diversified and reliable data. The lack of a credit bureau, like we have in some of the other African markets, where you can have both financial history and non-financial history. The lack of financial education of clients, that's a big part of our financial inclusion agenda, and that's why we have a business incubator that focus on financial education for SMEs. We're the only bank in the country that has an incubator for businesses that focus on that. There is, of course, the low formality, even comparing against other undeveloped countries. And even when you look at Southeast Asia or South America, the formality issue in Africa is much bigger. And then there's always limitations on data sharing and cloud access and all of the specific regions of the regulation of the country. But we're looking at how can we do this? How can we have some enablers like credit scoring for value chains? How can we work with entities that can do some debt advisory on SMEs on how to prepare themselves for lending, using these ecosystem data that we are a big bank from a value chain perspective. We bank the large corporates, we bank the SMEs, we bank the retail clients. So we have a lot of ecosystem data that needs to be used. And so we think how to apply that to lend more, basically. I think at this point, we just want to lend more without burning ourselves as much as we did in the past.
Thank you very much, Bernardo. You covered far more than I expected in the first 10 minutes. So thanks very much, because you opened the field of many more questions. So that's dangerous for you. The next, you already made the transition. We go to Catalina. Obviously, the reason that you both in this panel is you have a project together, yeah. And I think you should basically elaborate on it as he asked you to do.
Yes, thank you very much, and thank you also Florian and Bernardo for setting up the stage for this discussion. And I will just cut to the chase and focus more on the technical side, which has two parts to it. There's the data, and then there's the models, and they have obviously an interface, but each of them is important, and they pose their own opportunities and their own challenges. We have heard how traditional credit scoring gets done based on data such as credit history, P&L statements, balance sheets, and so on and so forth. For many SMEs, this is not available, or it's scarce, it has many gaps, it has low quality. So what do? Well, when the input into the scoring technique is not available, we have to replace it with something else. So the challenge is really to find the type of information that has enough explanatory and predictive power, enough content for, let's say, the latent thing, the latent factor that we're really trying to get at, which is the credit worthiness of that particular applicant, that particular obligor. And that brings us to alternative data, broadly defined, alternative as compared to the traditional sources. And these alternative data can come in many shapes and forms when we are in the SME universe. Previous studies have looked and have studied the importance of transactional data. We're talking here mobile money, we're talking e-commerce, we're talking cash flows, so anything around transactions that could be used as proxies for creditworthiness. And then there's the so-called behavioral data, which ranges from things that you can get from mobile phone providers. How often do you place calls? How often do you send SMS? How often do you do top-ups? What type of contracts do you have? Even some sort of psychometric profiles. There have been studies that in psychology that looked at the link between someone's patience or impatience and the likelihood, the probability that they're going to repay their loan. So there is a predictive power there. Then there is, let's call it administrative data, such as utility payments, the frequency and the regularity of payment utility bills, GPS locations sometimes, obviously tax filings if they exist. And finally, the fourth broad category of data that has been studied is the social network data. And here we don't mean just in terms of postings, what do people upload, videos, text, and so on and so forth, but in terms of relationships, that there is separate large area of research in social science around network theory, which looks at ways of quantifying persons or organizations and entities position in a network, the strength of their ties, whether they are a focal point or whether they are at the periphery, and then linking these measures to various outcomes around productivity, around success, around likelihood of repaying their loans. And so social network data could be used as a proxy for studying networks of commercial relationships when we're looking at the principles of these SMEs. So that's just a broad overview of data that has been traditionally thought of providing explanatory power. Some of that has actually been used in consumer credit scoring. The innovation would be to extend and to test these approaches to SMEs. One important thing to keep in mind is that it's unlikely to be a one-size-fits-all approach. So this type of data, or the usefulness of these digital footprints, let's call them like that, will very likely depend on sector and also on geography. So we can, for instance, imagine that for a country where a large part of the economy is based on the agricultural sector, one important type of data might be related to weather, to the quality and type of soil, like we were discussing recently. These are not even individual data or private data, but they have not been traditionally used in credit scoring setups. And such data may be a bit less relevant in the context of, for instance, industrial production. So no one size fits all. It's on a case-by-case basis. We will have to try to see what types of data work. We will also have to see where this data would be available from. And that raises a whole host of other issues, as I'm sure Esselina will talk about later. It's also brings us into the second point of this challenge, which is the models. Traditional credit scoring based on typical standard methodology scorecards deal with largely quantitative and structured data. However, alternative data sources are completely different species altogether. They are much more granular, they are often unstructured, they are very often in real time, so the whole intensity and velocity and volume of data is on a different scale than for structured P&L statements, for instance. Which means that from a methodological point of view, even after the data is there, putting all of the bits and pieces together into a coherent framework and designing a system, an analytical system that works to give us a probability of default will be challenging. So that's where the more modern methods of machine learning, AI more broadly, but machine learning specifically, will come in. And here again, we're looking at a division between two broad separate approaches. And each of them has their advantages and disadvantages. We have the more classical technical approaches, such as the regression modeling techniques, the decision trees, which are well understood. They've been there for a while. They've been applied to many different setups, and they can accommodate these types of data to some extent. Their large advantage lies in their interpretability and explainability, which is a very important point when you're dealing with credit decisions. We would love to be able to use them and to deploy them with alternative data. The challenge is that they are not very well suited to dealing with high dimensional data, as there would be the case here, many different measurements across multiple time points. They are also not particularly suitable in dealing with data whose dynamics exhibit complex nonlinearities. These regression and decision trees are mostly made to detect and evaluate linear relationships, but credit dynamics may be highly nonlinear. And so what I expect is that there will be more and more of a need to go to the second class of methods, which is encompassing techniques such as gradient boosting, support vector machines, deep learning, that will be able, they have enough flexibility to deal with high dimensional, highly unstructured, nonlinear dynamics in our data. But that unfortunately will also have the challenge of the black box. So we will run into issues of explainability, of interpretability, of being able to figure out exactly which driver is more important for the probability of default, and so on and so forth. There are ways of dealing with that, but it is not straightforward. So it's a work in progress there as well. Another thing maybe to mention is that this approach of going for alternative data, putting different sources of data together, needs quite a lot of infrastructure. We're looking at data that comes from public-private partnerships, from different data providers, from different heterogeneous data sources, different systems. So there will have to be some integration, some cooperation, and of course a very clear pipeline in terms of data acquisition, data cleaning, data curation, data safeguarding, to have all of the systems in place that can ensure an ethical and fair and transparent use of such alternative data sources. Deep topic, wide field, but maybe this is the right moment in which to pass it on to Esselina.
Yeah, I mean, she did it. So consider she moderated. It's for you now. You know, no, I think clearly the issue is on your side, Esselina. I mean, this is an open field in terms of all the issues we have to tackle. I mean, it's obviously about regulations, obviously about the way to tackle data privacy, data quality. You just put in the discussions the issue of black box. You know, one of the main issue when you look at credit scoring is the capacity to explain someone you decide not to lend, why you don't lend. So black box is clearly something that is strikingly an issue. So choose whatever you want to treat first. Then we will come back to what you didn't treat.
Okay, thank you first to be part of this panel. And thanks for my colleague that initiated to set the scene and also to present their view regarding this very important topic. During these 3 days, it was clear that for all of us, the development of SMEs is a key component for development of each nation, each country. So, and also it is important that we have in mind that in terms of statistic, we do have that in main developing country, or at least in the country where I come from, most of those small companies that are at the informal market. And then the data from there we'll have to check how we get the data for those companies that are informal. Secondly is that we also know that in terms of new companies, new entrepreneurship that are coming to the market that do not survive for more than 3 to 5 years. That die after that period, and there are different reasons. And one of the reasons is access to finance. And then there are reasons why the access of finance is so difficult. It's why for me this topic that we're discussing is very important to discuss how do we unlock this access to finance for SMEs via credit. So it seems here that at least we're talking initially for the institutions that are already formal, because in order to have the credit, you need to be already formal. We do have also a problem for that one, but we can also discuss the issue on how those informal can come, and maybe the point that Bernardo was talking about, the incubator can help us to bring this component of company. In terms of data, you are asking what is the perspective that a regulator might have. First, I have to say that some years ago, and I don't hear the main reason why we didn't move too much, but it was a discussion to have a private credit bureau, private data where all those bills, all other information that is not related to banking sector as such can be stored, and the financial sector can have access. That process didn't move as fast as we were expected, but the regulation is there, the law is there. I think that we are now in position to see how this credit bureau for private service can be more active, because can be a very good source of information. The information that Catalina was mentioned coming for bill service or service that are coming, we can have, and then we can see what is the behavior of those companies that are having data there. I see also other components, particular for the company that are informal. I think the mobile money and the mobile operate itself for the phone is also a good resource, because many people that are having, they are using also mobile. So we will have to think how those information can be used. So I do think that yes, we are in position to discuss and try to see how other information can be put in the basket to take the decision how we give the credit. The point will, what Catalina was mentioned, in terms of model, in terms of infrastructure to manage all those information, the quality of that information, but I think the model that where we see that Standard Bank, together with the institute in your institution are doing, might help. Probably, maybe with the information that is in just one institution, might be not enough to have a strong model. And this is where maybe we'll need to see how we get other, putting more data so that that model is not serving for one institution, but that model is serving to others. So I'm seeing the work that you are doing at Standard Bank as things in pilot, but we needed to see how we can accelerate and then how we can scale up for Mozambique and who knows also for others, to other countries, to see how such a model can be used. So I think it's a good initiative. We are at the moment, together with a regulator, there is a possibility that we do have information coming also from the banks, which will improve in somehow the credit bureau information that the central bank already have. And I think that maybe even now with the work that is in place in the pilot, we can see how more information can be put in the model to do that. And I'm thinking that also the interaction with the mobile money can help to see, particularly the mobile money that have already, if I'm thinking in the pilot, that I have already relationship with the Standard Bank, in order to see if the information that I have can be feeding in that model to make the model more strong, even in the pilot phase. I don't know if at this stage is where you are expecting me to talk about the other questions or another round.
No, thanks very much, Esselina. In fact, what I think what I would love to see happening would be either a conversation in a way between ourselves and the audience, but feeling free to sort of question each other on because again, this is, you talk about pilots. In reality, this issue is an issue we are facing everywhere, including in rich countries. I mean, Bernardo and myself, we've been operating in the same bank for many years, and in the banks we operated, we didn't lend money to SMEs if SMEs were not British. So, no surprisingly, this was a British bank. And so in France, lending money to SME was an issue because we didn't think we have enough info to conclude of the quality of the credit default on an SME. That was true for him in Portugal. So the issue is not an issue limited to developing countries. If we go up to the route of credit bureau, as you mentioned, and that definitely could derive questions to Bernardo, you, Catalina, and you, Esselina, there is an issue around the central bank and the way the central bank could use machine learning and AI. I mean, we had with Catalina example of the Central Bank of Romania, who we worked with, and we realized that they certainly discovered that with their own credit bureau issue, they could have a lot of info on the systemic risk of their SME market. So without even asking, we realized that regulators and central bankers could have access and could have a genuine interest into digging into data to get more information. So that's pretty much for you to reflect upon all that.
Maybe I will continue taking this last part that you mentioned. In terms of interest and willingness from a regulatory point of view, I think it is, because the development of SMEs, the access to finance for SMEs is a key point in country. And all contribution in order to make it working, I do think that the central bank is willing. So it's why I was talking for another project that it's not Standard Bank who's leading, but it's FSD is leading. I do think that there is a possibility to make them more willingness and interested to see how the data that they have already that can start generating and use model in order even to give back information to the banks in order the banks to use in their model for credit score. I see that there is a possibility. But being someone that I have worked at a central bank, I know that the timing is not in the same speed as the commercial bank. They're willing to see things. And you need sometimes more time to convince them. And it's why institutions like mine, they are, because we need to convince. And if we have evidence and we show them evidence, I think sometimes it's more quick for them to see. But there is a lot of conversation that you need to put in place. Yeah.
Yeah, maybe on the speed at which these things can happen. Yeah. So this is, I think, a very interesting point, because clearly it requires for us to have evidence from a pilot stage, proof of concept, on a necessarily relatively limited data, perhaps coming from internal resources, but we still have to think about where the alternative data sources would be. And then scaling it up. Once we have the evidence, then convincing the regulator that this is an approach that's worthwhile rolling out on a wider base, that will be the next step. The question is, what would that take to get there? Is that a question of informal conversations of bringing proof of concepts, or is there part of a regulatory framework that needs to happen? As in, does a law have to be passed that would allow banks to start deploying this technology at scale?
Maybe I would add one more question to this one, which maybe Bernardo would have a view on that, which is how mobile operators are linked to this thinking process. I don't know whether, Bernardo, you have discussions with colleagues running mobile operations in Mozambique. They have data that clearly are of great interest to the banking industry. And for some of them, they want to become a bank one day. So they clearly have a genuine interest to find ways to better understand credit risk. So maybe to participate in the discussion, I would love to know whether you already thought about it and whether you have connections with them.
Sure. What we've seen so far in the markets, and except Kenya, which is a little bit more advanced, the rest of the markets, we're still working closely with the mobile operators on lending on the consumer loan basis. So we've seen a number of products being launched by the mobile operators using credit scoring models with behavior and based on data to the individuals. Someone wants a 30-day loan, someone wants a 1-week loan, very short term, and towards the individual. Just that experience has been a little bit of traumatic in the beginning, because these markets are maturing still. So it's very difficult to predict certain of behaviors. Just an anecdote: when the first mobile operator launched a product called Tuna, which is getting a loan on a 30 days loan on a mobile operator, what people did was moving their mobile wallets to the mobile operator that didn't have the loans. So they would borrow on one, default on that one, and then move all their businesses to this other mobile operator wallet, because they're competing wallets in the country. And that mobile operator lost a lot of clients, and the other one won a lot of market share just was something that was a market improvement, but the behavior of the client was very different. So they've been trying to get this model of lending to individuals right so far. They haven't been particularly good at still attacking the acquiring side of the market, i.e. the merchants, which is where then you start touching into the SMEs and the informal SMEs and all of that. So countries like Nigeria, for example, they've got a very well-developed agent market where these informal entrepreneurs are agents of the bank and they drive their own business. So that creates a lot of data for them to lend into the agents or lend into the SMEs, because they're SME and an agent at the same time. So there's a big opportunity, I think, in countries like Mozambique to do that. As the informal market agents in the formal market, they become both selling tires and also selling financial services. But that creates a huge amount of data that can be used to lend to the tire business too, right? While also you have the behavior of someone that is responsible enough to act as a banking agent. So that is an avenue that I think it's still untapped in Mozambique with a lot of potential, is how do we move towards the SME market, using them not only as clients, but also using them as agents, plus combining both, and both of the data sets can help you lend into the business of these companies. So that is something that we're definitely looking at how to do. We're doing it as group in certain countries where we've been quite successful. Eswatini launched quite a good mobile wallet, I think, in Namibia too. And in Nigeria, we have a great agent business. So that those sets of data are quite useful. I think that is one of the avenues to go to, is giving them more stuff to do, more behaviors on the financial sector, on the mobile wallets, and then using those to lend into their normal business. What in terms of what, if I can touch on another point, Christophe, when Catalina and Esselina talked about how can we as an industry get together, I think there's also a trust among ourselves, right? How can we overcome the competitive side of the banks into something out of a market development, and everyone puts the same effort? Why is Standard Bank leading this piece and not Bank A or Bank B? So if it comes through the central bank, it's usually easier to get the markets to agree. I think that's a better point of entry. We've had many initiatives, and Esselina knows, where we try to lead it, but to open for the old industry, and it's seen as a little bit skepticism, is human nature. But when it comes from the regulator, everybody takes it as, okay, this is the Bible, so we have to follow it. So maybe the approach is to get the central bank on the side, understanding the benefits, and then extend it to the rest of the market.
Yeah, this is a very fair point. Before moving to the room, I think I probably would ask you, Florian, whether with your discussions with all the development banks and institutions, let's say development industry, is this issue an issue that is discussed? Do you know of initiatives where people are just trying to help? I mean, from my knowledge, I hear a lot about funds getting created to finance SMEs, which I'm very doubtful that it's fitting the bill. I mean, so do you hear about things that just would have in mind to help banks lending?
Thank you, Christophe, for this question. To be honest, I think I have more or less the same picture than you. I am not sure that this issue is a central issue for development banks, for development world. However, there are some projects. I have no specific project in mind, but there are some projects of technical assistance in banks, in institutions, to help them to upgrade their techniques, to maybe to incorporate new data and so on. But obviously, what I have in mind is rather financial project, and they are more focused on financial support in some specific sectors. Turning to financial support to the financial system, because there are many projects by DFI dedicated to banks or to microfinance institutions, is more often line of credit to support a specific segment of the market. But I am not aware, but I don't know all the world of DFI for sure, but I am not aware of specific project dedicated to this issue of information, of data availability. I'm pretty sure that some project exists, but it's clearly not the majority of a project.
Can I come in here to the conversation? Well, maybe after Esselina, but
no, go ahead. Go ahead.
Okay, so we're quite in an interesting moment. We've had some quiet periods in the past, but now, at least in Mozambique, we've seen a number of initiatives coming through that are quite interesting. So one is that the World Bank funded the Mozambique government around $300 million to create a mutual guarantee fund that is dedicated to guarantee banks on financing SMEs with higher coverage of the guarantees if it's women-led or if it's youth-led. So they start with 50%. If it is women-led, it's 60. If it's under 35, it's 70. And that is that gives us quite a lot of comfort because it addresses one of the issues on SME financing, which is collaterals, the lack of collaterals. So this kind of replaces the need for collateral. So that is one. We've seen another initiative from KfW recently, more focused on the agri sector, where not only are they providing similar guarantees to what the mutual guarantees give, but they have hired a private company that will work with the SMEs on the information piece around preparing the information packs that then the SMEs can submit to the banks. And that is supported by KfW. I like that part around, and I know the company and the partners that are doing it, and Esselina knows them well too. And they know how the banks think, now the private sector thinks around lending, and they will be helping the SMEs building the right information packs and also doing a first filter of what's financing and what's financiable. The third one that I would like is a very recently launched initiative by the IFC, which they are now launching globally, which is for the first time having a first loss fund. And this has been on a portfolio basis. This is something that I've been trying, we as a bank, we've been trying to pull for a long time. We've been sensitizing the development world around that, which is our appetite when we share. So if it's a 50-50 risk sharing agreement, I will apply the same credit process to my 50 as if I'm lending 100 or 50. I will not tweak the parameters of my credit. I will not loosen them because I'm always looking at not losing a part of my 50. When you trench it into a first loss mechanism, what you're doing is I usually tweak my models or my risk appetite to lose 7 because I know that 7 when I lend or 6 with the margins that you lend plus the ancillary, you make money. Now, if someone is guaranteeing me the first 10 loss, I'm going to tweak my parameters to lose 15. And still make a lot of money, or lose 17. So this is a new thing that the IFC from the World Bank launched. I'm quite excited and working with the team to see how we can do that in Mozambique. But that is the type of thing that increases our credit appetite. Now, if you can combine that with a different credit scoring model, this could be quite powerful because you already have a safety net for you to make a couple of tests. It's also adding extra capital to do pilots on this. So the timing of this, how these things are happening for us, is very, very good.
Yeah, no, and it is great because it helps you create credit history. So along the years, in 2 to 3 years' time, you will have a client that you will have in your books. You can follow if they still exist. Then you will have a client that you know better, and you can keep going. Thanks very much for Bernardo. What about the room? I mean, so let me. Don't move. You can introduce yourself.
Thank you. My name is Ailu. I'm from Ethiopia. My question is about alternative credit scoring system. I think this helps a lot in terms of finding, the creditworthiness of potential borrowers.
Speak a bit louder.
It's not okay.
Or getting closer to your mouth.
Okay, thank you. So I hope alternative credit scoring mechanisms could help a lot in terms of knowing the creditworthiness of potential creditors. especially in terms of like reducing adverse selections. But I wonder how much this could help in terms of reducing the moral hazard aspect of borrowers. And I would like the panelists to reflect on that. And the other thing is related to the overall financial landscape in developing countries. You know, our financial sector is pretty much underdeveloped, and we have the case where there are few big financial institutions like banks, which are normally grown in such a way that few owners are there, and it's only those few owners who are also privileged to get the money to borrow from them. How can we democratize these financial institutions so that they could be able to provide, you know, financial resources to the micro and the small enterprise? By their nature, they have been pretty much extractive because they have been taking resources from poor people and borrowing it to the rich people. And I think we have to change these kinds of things. I mean, together with providing alternative mechanisms of sorting out creditworthiness of borrowers and so on and so forth. Thank you.
I think that's probably for you, Catalina and Esselina. So, you know, the moral hazard, do you want to talk a bit about that, or you're not sure? Oh, that's Florian.
Thank you for the first point about moral hazard. Indeed, that's perfectly right. Credit scoring is a screening technology. So it's mainly a technology to discriminate before lending between bad and good borrowers, bad and good projects, for sure. But contrary to collateral, for example, collateral is it's not a technology, it's a way, it's an instrument that tackle both adverse selection and moral hazard. However, that's important is certainly the dynamic incentives, because when you have a loan for the first time, it's often a small loan with a short maturity, but you expect to create a credit history to have additional loan, larger loan with longer maturity. So I think this technology is not directly related to moral hazard. And for sure, if someone just wants money, go back with the money, you can't control for that. But it's a first step to incorporate a new borrowers and to build credit history for these new borrowers.
Maybe just to add for what you just said, I think it will be also important that when we develop the model, we make sure that, as Catalina was mentioned, that is ethically incorporate those aspects, that the model itself is not to discriminate different type of SMEs. So it's important that the model take into account those ethical things that at any time can be also, anyone can make an auditing to see that the model is not making discrimination.
Yeah, and maybe also just briefly to build on that, I'm going a little bit away from the topic of moral hazard, but building on Florian's comment about incentives, it's one thing to also realize is a lot of the alternative data that we talked about, not all, but a great part of it comes from these digital footprints. And so the question is the use of such data and the extent of the use to such data, the way that such data would have on the credit scoring models, would that perhaps create a certain bias towards those SMEs or those principals who are more easily represented in their digital footprints? What I mean here is those who have access to tablets, phones, and so on and so forth. Is that some kind of behavior, some kind of backgrounds that would tend to then be overrepresented in the data, and that would naturally lend towards the credit scoring systems to be not extending the same degree of transparency to everyone. That's definitely something to keep in mind.
Yeah, even if at this level, you get microfinance. So in a way, I would say the poor element of the lending exercise is in developing countries, very covered by microfinance. So when we look and what we currently are looking at is SME financing, which is the layer just above. So the one that can no longer ensure their own growth based on microfinance. And they clearly have access to a bit more data, a bit more info, and a bit more technology. In the audience, more questions? Yeah.
Thank you all. Maybe just one question about the competition versus centralization issue on this credit scoring aspect, because there's of course a public good dimension in the models or in the type of credit scoring you may develop with new data. And so my question is, what is your view about the regulation, but with respect to this specific point of competition versus centralization of the organization of credit scoring?
Should I pick it up?
May just add something to the Vianney's comment. I have more or less the same question and the same thinking, and it's also related to the private information. The private information is very important in lending relationship, and I was thinking about an old paper by Peterson and Wajan. Do you know maybe the paper, or Vianney? It's the importance of private information to finance new firms with many risks, and it's more or less related to the discussion of cooperation, competition. And
yeah, just to add to this issue of competition and centralization, and particularly in the point of view of data protection, data privacy, I think within those models, we'll have to take into account how this information is also making it public. How do you use the information that people have in social media and we bring to the model? So there are issues of data privacy that we need to take into account before the model is coming to use, and also this component of competition. I don't know,
yeah. If I can come here, I think it's more about making the data available than the models themselves. I.e., I think it's a responsibility of every institution to build their own credit scoring models, and then to fine-tune the rules according to its risk appetite. What would be, I think, a breakthrough from an industry perspective is that the access to the data is easier, or it is given to the industry. Because if we're talking about the role of the regulator to drive more appetite for SME financing and the growth in SME financing, is them making available to all banks data that can be scored better to give more loans. So the angle is not to give, I would say, not to give a regulator a credit scoring model and say give it to all the banks, is more, if we have access to this type of data, this is how much more credit can be extended to the SMEs. And this is a pilot with one institution. Now, if you drive regulation to make that data more available widely in the industry, it will force other players to build their own scoring models with that data that will drive generally more SME financing in the industry. So that's I think that will be for me the competition limitations is if you make it widely, you go into sector-wide exclusions as Esselina did, or you will remove the competitive side of lending to some clients and some banks having more appetite than others, and that's a competitive advantage that some banks want to have. But what would drive more SME financing is that more data is available so that banks build their own behavioral and credit scoring models.
Yeah, I think you're very right, Bernardo. And I would add one element, which is if you look at the way it works in well-established, lending activities in the G7 countries, in France, no banks are solely using a standard, credit scoring systems. Most of the big banks, they have their own. So they developed it, and they, for some cases, they're very different than the one from the other. So the issue is no one is forced to use the same system, and nobody is seeing it as a competition issue, as long as everyone has access to the same data. And I guess the issue of access to data is getting up to the credit bureau issue you mentioned earlier on, Esselina. The problem we have in developing countries is either credit bureau are not formalized, so they don't exist, or it's not mandatory for banks to provide info to credit bureau, or the info is in the credit bureau, but to get access to the info, you need to pay. So it means that competition is totally flawed by the newcomer, the poorest bank, simply don't have the money to enter into the lending market because it costs too much to get access to the data. So in a way, a well-organized credit bureau, an obligation to report the corporate information up to the credit bureau and put this info freely available to anyone willing to play a role in lending is probably the best way to tackle the competition issue. That doesn't mean that as we are focusing on new methods and new analysis, we don't need to share that. And that's the issue. We already had some talks with Bernardo. There could be at some point that we invent a sort of, let's call it an indigenous credit scoring tool. It could very well be that at some point you believe this is a common good. And in a country, let's say, to tackle agricultural risk, you want to make that available to a larger crowd, not only to a bank. And that is an issue about the sandboxes that we got in Kenya. We need to find the right balance between doing it at some point or doing it in the beginning. That's the principle of the sandboxes. So we probably have, for all of these, to accept that the first that will pilot the innovation will have some time to benefit from it. And that's what created M-Pesa. Without that, there would have been no M-Pesa. So in a way, that's probably the way I would see it. The data is the key, but sandboxes for models is another element. More questions? More questions? Yeah. Yeah.
No, sorry. My question is just related to the previous discussion. I perfectly agree with the idea to share data and let every banks, every fintech, or as you want, to develop their own model, and the competition is at this level. My question is, we are talking about alternative data, and which incentives are data provider to share data? Because it's clear for credit bureau. Okay, I agree. But for telecom, why, if I am telecom, why I am sharing my data? What are my incentives?
The regulator will make you share it. That's the incentive you have.
No, I think I provided an answer to that earlier on. That's my feeling, which is the data providers that have the most data are telecom operators. And telecom operators, all of them, wants to become a bank. They want to lend. So in a way, the incentive they have is if they help the community to create models to evaluate credit risk, then they will benefit from it. And that's the same system of sandboxes. So if they do it well, they will be the first one to have it, then they will be the first one to benefit from it. So for mobile operators, my feeling is there is a very, very, classic economist approach of it. I mean, they will benefit from it. But that's my view.
Do you think that they will not charge you at the point, in the initial point?
I think for us trying to build a pilot, I think they will not charge. But they will expect to get the only one to use it for a period of time. So which is pretty much back to your question.
Can I?
No, I was just wondering to address this information access problem, whether, presumably the firms own all of these data themselves. So can they just could we make it easier for them to authorize their e-commerce platform, their telecom company to provide that information to a bank that in a way that's verifiable? And therefore that's a responsibility of the applicant without having the telecom company have to make that decision.
Whether we bypass the intermediaries such as have the data, so they can provide the data directly to banks without intermediaries. That was your question. That, yeah, that,
A quick comment. Yes, I mean, that might be possible. Question is to have the framework in place into which this is happening, and that might limit the size of the data set as well, because you would not get all of the information that way, very likely.
and probably to comment on your point, Florian, it would mean that credit bureau would no longer be called a credit bureau. It would be a data bureau. And there will be more than credit information. Yeah.
Maybe
that idea of having a data bureau is something that might work, particularly when all of us will agree that in the digital economy, the most important element is data. So we need to organize where we get the data and how we get the data, the quality, all the procedure to get data. Maybe some things that is need to be in the table of thinking will not be all for credit scoring, will be data for other different elements of our work at the digital economy space.
Maybe just to come back on this issue of sharing the model or sharing the data, maybe it's a little bit naive and theoretically abstract and all that, but you have three cases. Either the bank lands and the project is a success, the bank lands, the project is a failure, or the banks do not land. And for the first two cases, of course, you just need to have access to the information, and you can recover all what you need if you want to build credit history, credit scoring. But for the third case, I think that's where the model is important, because you would like to know on what basis the bank did not give the credit, and well, maybe sharing the data is enough, and everybody will do reverse engineering to recover the model based on this decision. But that's where I guess there is a value for sharing information on the model, so that the learning curve is steeper for the machine learning approach.
Yeah, I think Catalina, this one.
If I can just quickly jump in here. So I think this goes back to a point I was trying to make earlier, which is that there's no one model that fits all the cases. And there's many reasons why the bank may decide not to lend. And it builds a little bit also on Florian's earlier comment on private information. There are some things that are just going into the lending decisions that are not necessarily coming from the model, and a model that may be appropriate for one financial institution may not necessarily be appropriate for another. I think, again, the access to the data is important, some of this data would actually come for any financial institution from their own data pools, perhaps data that could still be construed as alternative because it hasn't so far been used in credit scoring systems. For instance, information on their accounts and accounts movements and things like this. Again, I think that the extent to which each financial institution is working to a model that will be limited. Also because these models change. As Bernardo mentioned earlier, how parameters may be tweaked according to certain market conditions, according to some incentives, according to the regulatory framework. The models do evolve. And so I think there's a certain degree of flexibility that is needed for each institution to build their own framework, their own model, their own scoring decisions. But we need to ensure access to the alternative data, because otherwise, indeed, the competition is a problem.
Yeah, but still, you talked about black box, and I think what you're referring to, Vianney, is you know, someone gets to see the bank, is asking for money, and then in a week he is basically hearing that the bank is not ready to lend. Immediate attitude is, why? My project is a good project. Why don't you lend? Then the issue previously, we, old banking exercise, we don't lend because we're not, we don't have trust in your project. And why? On this, and this. And in some cases, the bank is providing a way to get out of the issue by modifying parameters, putting some collateral, changing expectations, whatever. Here, with alternate data and marrying heterogeneous data in an AI-inspired model, what could we say? And if we just look at it as this is something that will be potentially put in place, could we, as well as we implement it, could we implement a sort of the right way to explain? Each time you say no, you give arguments, and you know that the arguments are fitting the model, which normally is obviously is not something you would expect from a black box. But if a bank wants to be credible, maybe the bank needs to have this tool explaining.
Yeah, and this is definitely an area in which a lot of work, technical work, has already been done around explainability and measures for defining feature importance, meaning which variable carries more weight, and then you look at where is this particular applicant on that variable scale and how can that feed into their score and the final decisions. So that can be done. I would assume this is also important for the regulator to basically approve the use of such models. However, what I think is also important, and I think this is a little bit the distinction that is that's crucial to make, when we talk about black boxes, we also need to ensure consistency. So interpretability is one question. The other question is, if you do the process again with similar data, would you still reach the same decision? And that goes to the question of bias. And earlier models, that was not the case. Because you could say, okay, I build a model, a deep learning system or neural network with many different layers, many different types of neurons. I get one answer, one decision. If I do it on exactly the same data with a different structure of the architecture, I get a different decision. And that is dangerous. That's not acceptable. And I think nowadays, with the recent advances, recent work that has been going into the field, we're in a much better position to avoid that feature and to really be able to focus much more on the interpretability. And there, indeed, there are solutions.
Thank you. More questions? I see that we still have 5 minutes. So if there are no more questions, maybe what we could do is have very quick circulation of the bâton de la parole, and make sure that each one has a minute to pass. I would say a sort of positive vibes on the ID. We talked about pilots, but pilots to what? So I don't know. Maybe we start with you, Esselina.
I think this discussion for me make it very clear that the discussion of how we are unlocking SME access is important, and then that we need to improve the way that we are doing at the moment. And data is crucial, and we need to work in the way that any institution that want to use a model having other data know where the data is, and anyone can have access, assuming all the protocol that are necessary to have data. So for me, is that we still have to work in that area of improving the way that the SMEs are getting access to funds.
Catalina?
Maybe just 2 points here. One is that a lot of the discussion in this area tends to be rather static, in the sense that we're looking at the past data, historical data, maybe even recent, to build a model that's going to help us to predict the future. And 2 points there. While we're doing that, we're really setting up the framework for how things will be done, not just now, taking the decisions now, but also what data should be collected to begin with, how should it be stored, how should it be treated, what models can be entertained and developed. And I think it's important to keep in mind that we're building here a methodology that, like any methodology, will be evolving as times change, as the economic conditions change. But ultimately, it's competition aside, it's also about making the pie larger for everyone, for financial institutions who lend, for SMEs, for the economy at large. And I think that's one thing that's good to keep in mind.
Thank you. Bernardo?
So for me, it's clear that whatever we've been trying to do in traditional credit scoring models up until now is not working. From undeveloped to developed countries, we either overdo it and we reduce a lot our credit appetite, or we underdo it and we have large losses. And I've experienced both in different institutions. So my hope is that machines will do it better than we do. They read data more accurately, more data quicker, because time is of essence also. We've seen a lot of taking 3 weeks to look at the credit case of a SME when a machine can do it much quicker. So I do think in this case in banking is one of those where the machines can really help us overcome some bias and make better decisions with more accuracy, and therefore once you do that, you will unlock a huge potential for the economies and employment, because clearly in all of our countries, SME is the biggest employer of the economies, and it is absolutely crucial for Africa, for example, to create employment, given the growth rate of the populations. So otherwise, we're going to have a big problem, not only in Africa but in the world. So this can really be something that can help globally.
Great. Florian?
Thank you. Indeed, my main takeaway of this discussion is more global discussion, is about the importance of access to credit and the importance of reducing information gap between borrowers and lenders. And what I keep as a general perspective from this discussion is the importance to have both private and public initiatives to develop a new platform, new structure, or a new way to reduce these information gaps. It's not a solution by the private sector only, it's not a solution by the public sector only, but it's a cooperation between both public and private sectors.
Yeah, fine. So I have nothing else to say apart that it seems that there is something achievable, so which is positive. And on that, thank you very much.
Thank you. Goodbye. Ciao. Ciao.